Hello everyone, welcome back to this training on finance for non-finance professionals. In this session, we would be starting off with the aspects of managerial accounting or management accounting to be precise. We have discussed for a few sessions the various aspects of financial accounting, where we have focused on the aspects like the income statement, the balance sheet, the cash flow statement, and a bit of understanding into the analyzing of the financial statements using ratio analysis, etc. Now, moving on to the world of management accounting, the first of these sessions would be more directed towards what is called as cost, volume, profit analysis. So, I'm looking at the three dimensions of the business: cost, how much is it going to cost me for a particular piece of task? How does volumes play a role in the profitability of the company? Volumes is number of items that are getting sold, number of items that are getting produced. How do they influence the overall profitability of the company? So we are looking at these three key aspects of the business. As we discussed earlier, whenever we talk about management accounting, the focus is on the internal reporting of the company. So, internally, from my control standpoint, a company would be more interested in looking at the dimensions like cost, volumes. How do these costs and volumes together result in the profitability of the company? With that background, let's look at the first aspect, which is the costs. Typically, people talk about costs in two dimensions. One is called as a fixed cost, the other one is a variable cost. So, whenever we talk about any costs we are incurring in the business, which has no relationship with the volume of the business or the level of activity typically called, otherwise, you can use the word no relationship with the volume of the business, means irrespective of how many goods you are selling, irrespective of how many items you are selling, you will incur that cost. Even if you sell 0 units, that cost is incurred for you. Even if you produce 1,000 units, that cost is incurred for you, which is the same. For example, the rent which you pay for an office, even if some business operation runs in it, some production happens there or not, some revenue comes for it or not, you are incurring that kind of a cost. So all those are typically called as the fixed cost. The rentals which you pay for your building, the insurance costs which you pay for your building again, and for any matter, for that matter, on anything, the insurance premium which you are paying, the salaries which you pay to the individuals, especially when it is a fixed base salary. Sometimes if the salaries are based on a commission basis, based on the volume of sale you are paid something, then it does not become a fixed cost. But if I say, irrespective of whether you sell 0 units or 1,000 units, your salary is fixed. You will get a monthly salary of something. These kind of costs are called as fixed costs. So they do not vary with the volume of sales or volume of the business, but they generally vary with time. It's not that they are fixed forever. They vary with time. What does that mean for us? The rent, at least for next 1 year, it is constant. But probably after that, it may increase a little bit. Salaries, at least for the next 6 months or 1 year, they are constant. So the fixed means it's not that it is fixed forever, it's at least fixed for a specific period of time. Beyond that, it is variable, but it has nothing to do with the volume of the business, whether the business occurs or not, whether the business is running or not, whether you are able to generate sales or not, you would definitely incur that cost. So that is the concept of fixed costs. And for a lot of capital intensive businesses, what do we mean by capital intensive business? A business where you have so much of investment done on machineries, plants, buildings, not much on raw materials. These are all capital intensive businesses. Probably purchase them once, you can use them for a long period of time. Those are all capital intensive businesses. And what you definitely see is in capital intensive businesses, the fixed costs will form the bulk of the total costs. In businesses like consulting, advisories, where you don't need to make any big investments. You don't need any machineries, you don't need any equipments. In those cases, the fixed cost may be much, much lesser. But in terms of those businesses where there is a heavy initial investment required for purchasing some machineries and all, you definitely see that there is a heavy volume of fixed costs in those businesses. And does it mean that, as we have said, they vary with time? But sometimes the fixed costs can be in the form of stepped fixed costs. What does this mean, stepped up? Probably this fixed. Let's say we are talking about, I took a small office space and I'm paying some 50,000 bucks as a rent. Now, until my employee strength is 10 or 15, the office space is more or less sufficient. But if my business is growing to such an extent in no time that I need 30 people, now this office space is no more sufficient for me. So I have to expand to a different space, which means even in a very short time of span, the fixed costs can typically go up for me. That is when there is a sudden spurge in the business, either in the positive or a negative direction, and an extra fixed cost or a reduction in the fixed cost is happening in a slightly bulky amount, and that is what we call a stepped up fixed cost. Again, it's fixed, but because of the change in volume, there is either a big increase in the fixed cost or decrease in the fixed cost, again for some period of time. Those are called as stepped up fixed costs. So we need to understand every cost that we are incurring for our business. I need to know whether it can be classified as a fixed cost or not. Sometimes there could be some kind of costs which purely vary with the volume of business, which means just like raw materials. If I want to sell 100 units, I will produce 100 units, I will buy the raw materials for 100 units. Or if I am talking about labor, whose intention is to just produce the product, if I am thinking of producing 100 units of the product, I will hire the labor accordingly. If I don't want to produce anything this month, I don't need to hire the labor. So these kind of costs which I am incurring, where I can directly associate the cost to a unit of output, we call them as variable costs. So which means if I am producing 0 units of a particular product, the variable cost will definitely be 0 only. So that those kind of costs where if I am producing 0 units, the cost is 0. And as the number of units that are produced or sold is increasing, the variable costs also keep the costs also keeps growing up. That is what those kind of costs are being treated as variable costs. So with the sales, the costs go up. With the number of units produced, the costs go up. Those kind of costs we are treating them as variable costs. And we also have some kind of costs which could fall into a semi-fixed and a semi-variable kind of a category. So what do we mean by those? Some part of the cost is fixed irrespective of the volume of the business. I have to pay some amount of costs, and if the business is going up, I have to pay something extra. The typical telephone rental, irrespective of whether I am making even a single call or not, I have to pay a minimum amount. But once I start making calls, if my business is growing, I'm assuming that I have to make more and more calls as a part of the customer service. So with the volume of business, probably my telephone costs also will go up, which means there are two parts in it. One is a fixed cost, which is a telephone cost, even if my sales are zero. And there is some portion which will result in if my sales are existing. If my sales are higher, probably I may have to make more phone calls, which could result in my total cost going up over the telephone. Similarly, let's say electricity. If no business is running, I will have minimum electricity charges. But if my business is running, producing some sales, probably I need more people. More people means more electrical equipments, air conditioners running, the lights running, and various other electricity equipments running, which could result in electricity expenses going up, which means some portion of the electricity expenses for my business are fixed and some portion are variable. So if we see, if I try to plot a graph where I talk about the volume of the business, when I say volume of the business, it is in number of units sold. Number of units sold on the x-axis and my total costs on the y-axis. So if at all I am selling zero goods, I am still incurring this much because that is the fixed cost. Whether I produce even a zero units or not, my costs are still existing. That is what is contributing to the fixed costs. But as we are seeing, as the volume of business is growing, even the variable costs are typically going up, which means my overall costs are actually going up. As the volume of business is growing up, the overall costs are also growing up, which means I'm not seeing actually a horizontal line here. I'm seeing a line which is sloping upwards. So slope, this slope is an indicator that there is a variability in my cost with the volume of the business. So if the slope is very, very steep, then it means that my variable costs are very, very high. Change in 1 unit, it is going to increase my cost by a large number. But if the curve is more or less flat, if the slope, if this upward sloping line is more or less flat, then it's an indicator that my variable costs are much, much lower. An increase in the volume of 1 unit will not increase my overall cost by a larger amount. So that is where I'm saying the slope of the line talks about the variability cost per unit. The higher the slope, the higher is the variable cost per unit, and vice versa. Whereas the fixed cost is always fixed and you will see it as a flat line. All right. So the first part that you need to understand in this session is any cost that come in your way in the business, you need to know whether it can be treated as a fixed cost or it should be treated as a variable cost or it can be classified into a semi-fixed, semi-variable kind of a category. Once you are able to categorize them, then we will do a bit of more analysis on these costs, linking the cost with the volume and then the profitability of the business. Now, moving on to the next aspect. Once I know what are the different kinds of costs, or how am I classifying my different kinds of costs, all I can look at now is what is my break even point. What is the meaning of break even? When will my revenues exceed my profit, my costs? At what point, at how many number of units, at least my revenues are covering my costs? So if you see here, the the flat blue line is my fixed cost. The rising blue line is my total cost per unit. So the gap between the total cost and the fixed cost line, the vertical gap between the total cost and the fixed cost line, is nothing but the variable cost per unit. This is called total cost per unit. The horizontal line is the fixed cost per unit. So the vertical distance between the total cost per unit and the fixed cost per unit is the total variable cost per unit. And now, under the assumption that as the volume is increasing, my total revenues also increase, right? Or preferably the fixed costs. Yeah, let's look at it slightly differently. Let's look at this chart again. Something which I can make out here is, this is the horizontal line, which is my total fixed costs in the business. And what we are observing is the total fixed costs are fixed. Irrespective of the volume of my business, the fixed costs are fixed. Whereas, because my business has some amount of variable costs, what we are seeing is as the volume is increasing, my overall cost is also growing up. The reason being, this is what is being contributed by the variable costs. So the upward going up line is my total costs involved in the business with this much. So at this point, this is my fixed cost and this is my total cost, which means the difference between these two is my variable cost. And the same way, if you look at this pink line, this indicates that as the volume is increasing, which means if I'm selling more and more, my revenue is increasing more and more. Here, this kind of a straight line is coming only under the assumption that for all my units, I'm charging a fixed price. Right? Then only a flat curve or a straight line is very much possible. I'm charging the same price for all the goods. So with the increase in one unit of the good, I'm able to make a revenue which is increased by a similar extent always. Now what we are seeing is the revenue is going up, the cost is going up with the volume of the business up to a certain extent. At a certain point, we are seeing that the costs as well as the revenue, both of them are intersecting each other. And after that, we are seeing that the revenue is going up compared to my total costs. This is the point where my total cost curve is cutting the total revenue curve or line, is what we are calling as the break-even point. What does it mean to me? If at all I have to break even or probably no profit, no loss scenario, if at all I have to enter into a no profit, no loss scenario, I need to produce and sell at least this many units. So if I am producing any number of units below this, I will encounter a loss whose amount is equivalent to the distance, vertical distance between my total cost line and the total revenue line. Whereas if I am able to sell more and more units beyond this point, I'm seeing that the total sales revenue line is higher than the total cost line. By that much extent, I would be ending up in a profit. So the break even point or the break even chart will help me understand what should be the minimum number of units that any business should be producing and selling to make a no profit, no loss scenario, or to just start up the profits in the business. So that will talk about the volume. What should be the minimum volume to become profitable in the business? So that is that kind of analysis which we would be dealing with is called as the break even analysis, for which we need to understand a couple of terms. Just now we have understood it from the graph what is meant by break even point. It is that level or it is that volume of sales, that number of units of sales that should be sold in order to get into a no profit, no loss scenario. Anything lesser than that, the company will enter into a loss. But yeah, if the company is able to produce and sell anything more than that number of units, it is going to make into profits. So the number of units where the total cost is equal to total sales revenue. This is very much important because total cost will combine total fixed costs as well as total variable costs. Fixed cost does not depend on the volume of the business, whereas the variable costs are very much related to the volume of the business. Right? So a simple way to calculate what should be the number of units is nothing but, as this formula is highlighting, the break even volume of sales is nothing but take it as fixed cost per period divided by the contribution per unit. How do you, let's try to derive it a little bit. Let's say I'm selling some X units of the good, and each good I am selling at a price called P. So my total sale revenue is equal to XP, and let's assume my fixed costs are F and my variable costs are some V per unit. Because I am selling X units, my total variable costs are XV. Whereas fixed costs, I don't need to put XF because they are fixed for whatever may be the volume of the business. Now, if I try to simplify it, how much it should be the X? A simple mathematics will tell me X into P minus V is equal to F, whereas X equal to F divided by P minus V. What did we think of P and V? P is nothing but the unit selling price, whereas V is the variable cost per unit. Now, understanding these two things, the difference between the selling price per unit and the variable cost per unit is nothing but the contribution per unit. This is another jargon you have to be comfortable with. Whenever we say unit contribution, it is nothing but unit selling cost, selling price minus per unit variable cost. So once you know what is your break even point, which means what should be the target for minimum number of units that you should produce and sell so that you don't encounter a loss. So this word, this value of break even point is one of the important tools in the business for risk assessment. The reason being, if any company is setting its target just above the break even point. Let's say my calculation has come out that my break even point is 100 units. So if my target for the next month is just 110 units, then I'm risking myself, because even in some circumstances, if I'm not able to meet the target because of some extreme circumstances, if I'm not able to meet my target or fall below 110, there is a good chance that the company will end up into a loss. So the simple way to assess is based on the break even point. The company should really assess whether it has set its target slightly above the break even point or way above the break even point. Anything slightly above the break even point would be a risky scenario for the company, because any small drop in the number of units could impact the profitability of the company. So that is where any risk assessment model will talk about the usage of margin of safety. Margin of safety is nothing but it is that level of volume of the business, that level of number of units which is above the break even point. How many units is my target? Way above the break even point. If it is much above the break even point, I am in a very safety zone. Otherwise, the company is risking itself. So the word called margin of safety is nothing but what is the target in terms of number of units which is above the break even point of the company, right? And a couple of more things to understand in the break even analysis is, from a company's standpoint, is it the fixed costs which are high, or is it the variable costs that are high? The reason being, the higher the fixed costs of the company, the higher is the riskiness associated with the company. The reason again, even if the company, because of some bad economic scenario, it's not able to produce and sell a minimum number of units, it is going to encounter big losses. Look at this formula. We said the break even point is fixed cost divided by the price minus the unit variable cost. So if the fixed costs of the business are very high, it will have a big onus on the company's break even point. So the break even point should be set at a very high level. So if the economic circumstances are not favoring that particular company, it will definitely go into losses in those years. That is one of the prime reasons anyone has to analyze the composition of the fixed and the variable costs in the company. And that composition analysis between the fixed and the variable costs of the company is what we call as the operating gearing of the company. The gearing ratio, whenever I talk about the operating gearing aspect, it is nothing but the extent to which the costs in a company are fixed compared to being variable. Because the higher being the gearing, the higher will be the fixed, which means the higher is the risk associated with the company. So most of the companies which have gone bankrupt, you could very well see from their financial statements or from their numbers, they have a huge proportion of costs in the fixed form. So one or two bad years in terms of economy, one or two bad years resulting in lesser number of sales, overall resulting in huge losses being piled up for the company. So as an alternative to the break-even chart, which we have discussed in our earlier slide, we also look at what is called as a price volume chart, which is nothing but, as we are seeing, the profit volume chart. As we are seeing, it's nothing but a chart between the volume of the business and the profit associated with the business. So below the break even point, the profit is negative, which is the company is making loss, and above the break even point, the company is into profit. And we are also seeing that the higher the volume above the break even point, the profit area is actually increasing. The lower the volume below the break even point, the loss area is increasing. So the company should set its margin of safety way above the break even point, so that even if the economic situations are not favoring the growth of the company, things will not be very bad and the company will not incur into very huge losses. So as a part of this, I expect that you got the comfort level in terms of the break even point. How do you compute the break even point using the fixed costs and the variable costs along with the total revenues? How do you look at the break even point from the chart, break even chart or the price volume chart? Wherever the profit volume chart, wherever the profit line intersects the volume line, that is what we are calling as the break even point. So understanding of this is a very critical aspect to take appropriate decisions and to assess the performance of the company. All right.